Hey everybody, Brian Ladd here. I'm looking forward to going over this webinar today. We've got quite a bit to talk about, but we actually kept the curriculum and the number of slides down to a very manageable range so that what we're going to do is leave a lot of flexibility for two-way discussion with you if you'd like. But we actually think we're going to be able to deliver this in about 20 minutes. So we want to be respectful of your time. But we've got that chat and the Q&A open. Probably the chat's probably the easiest way. If you have quick questions, we're happy to get to them. And we're going to start this here in just a minute or two. It looks like people are joining. But Steve, would you mind flipping to the next slide? We have a fun way to what I'd like to do is hear from you. If we were all in the room together, we would probably have a little more accurate read on kind of how everyone was feeling, what everyone wanted to talk about. But we've got a Menti poll in the top right. And so if you're watching this on a laptop or something, you can put your phone up to that and scan it and go and put an answer in. Or if you're on your laptop, just go to menti.com and put in that code. What that'll allow us to do is get a kind of an accurate read on what you guys are feeling and what all we're going to ask for on that. And when you feel appropriate, Ronald's behind the scenes, if you could kind of share your slide as that starts to pop up. What I'd love to hear is kind of how you guys are feeling in general about what's going on in real estate, and that'll help us inform the conversation today. Steve, what do you feel about that? Is that what we're hearing from clients on a daily basis?
Yeah, it is. And as if anyone's seen these mentees before, the larger the word, the more people have put some weight behind that or put it. But yeah, there is a lot of confusing, challenging, stressful, which is we've been saying that with our clients. We see it on both ends of it right now. It seems like both buyers and sellers are afraid to make a mistake, and they're confused, and they're hearing one thing in the news, and then they're maybe seeing their neighbor's house go quickly, and then they see another one sit, and it's a confusing time, and we're certainly seeing that on people's responses.
Yeah, interesting. Yeah, and what I really want to get to today is kind of dispel some of the myths. And Steve, if you want to switch back over into our presentation here, is dispel some of the myths that we're hearing in real estate, because the headlines, as you'll see, are confusing, because some of the headlines that you'll see may just like confound your perception of what's really happening. Statistically nationwide, we're in a housing, what they call recession, not regarding prices, but a recession. There hasn't been this few homes sold per year since the mid-90s. And when people see headlines like that, they're like, isn't the real estate market crashing? But we've got some really interesting statistics to go over today that will help you understand that not only are we not crashing, but we're holding firm in where we're at, and then the trends going here. But the headlines are all over the board. They are quite confusing, and hopefully we can get to some details today that kind of help you get a little clarity on moving forward, either as a buyer, a seller, or a bystander in this market. At least you can get some understanding the fundamentals of what actually drives the supply demand equation of real estate, rather than usually what the press talks about, like the 40 or 50 anecdotal things that really have minor effects on the housing market or are a byproduct of that. But anyway, Steve, what I want to talk about is kind of what's happening on a nationwide scale. And then what I'd like to do is hand it off to you on what's happening here a little bit more locally. But a lot of people are saying, what's going to happen in housing prices this year? If we trust the experts, what we've done is put together a slide here. As of early January, this is 21 top soothsayers, experts in the market of what they, what's going to happen to housing prices in the year to come. The average is about a positive appreciation of about 3%. Wells Fargo and some of the banks, Goldman Sachs, whatnot, are on one end of the spectrum, and they're predicting higher rates of 3 to 5% appreciation. And then there's a few others on the other end that are predicting a little bit less, down to, you know, the worst case is there's someone saying -2%, but the consensus is really around positive appreciation about 3%. To me, who's, you know, I've been in real estate for 26 years now, that feels good to me. Historically, price appreciation is anywhere from 3 to 6, 3 to 7% year over year. And that's an equation that creates balance between buyer and seller forces, so that people can make methodical decisions. Housing was never meant to be a commodity or an investment that went up 10, 20, 30% a year, because that creates bubbles and then, you know, all kinds of bad situations in people's lives. So for me, I feel reassured when I see projections and forecasts like this. Steve, do you want to jump to the next one?
Yeah, absolutely.
Yeah, so let's, you know, basically Freddie Mac, you know, who we all know, they're predicting, you know, prices to continue to grow at a slower pace. And Freddie Mac and Fannie Mae hold about 70% or back about 70% of all the mortgages in the US. So if that's coming from them, I think that's kind of the most reliable, you know, simplified quote about how they feel nationwide about where housing prices are going to go. And the next slide is in the main product that has been driving what's happening are mortgage rates. And so we just got some news again today. The Fed chose to hold interest rates and not drop by a quarter point, much to the dismay of the new Trump administration. But where we stand with that right now is that given the increased risk of inflationary pressures with tariffs and whatnot, the Fed is tapping their brakes and with some of this sticky inflation, and they're going to slow down their drops on the interest rate, which has an indirect correlation on what mortgage rates are. Basically, to sum it up, I think we're going to have a very stable mortgage rate scenario and less of the price decreases that all the experts were predicting only 3, 4, 5 months ago. And so what we're really putting ourselves into is a situation where the forces are not changing that much. For the sellers that were waiting for interest rates to go lower so that when they sold, they could buy a new house at a lower interest rate, or for the buyers that were on the fringe on waiting to see if the interest rates will come down a little bit before they made that purchase, those decisions are being forced. Either they're throwing in the towel, you know, if you want to go to the next slide, either they throw in the towel and say, I'm out, I'm going to give up, or they're going to say, I'm just going to accept the bitter pill of which it is now. And that's the situation that we're in right now. Steve, are you kind of hearing that sentiment from people that have kind of been sitting on that fence for the last couple of years?
Yeah, absolutely. I mean, we've said it before. Generally speaking, you started the webinar with this. Housing usually is done for a fundamental reason, right? And so when people are putting their lives on hold, waiting for a lower interest rate, waiting to see the results of an election, waiting to see what would happen in the new year, they're putting their lives on hold and living with too much space, too little space, don't like where they're at, need to be closer to family. And they're doing it for good reason, because these are real numbers. When you're talking about interest rates that have gone from 3 to 7, it's real. But now the expectations are not, they're very clear that the expectations are not that they're going to be going back into the 5% range. And so to put your life on hold for another year for maybe a 0.25%, that changes the dynamic. And that's the conversation we are hearing repeatedly from both sellers and buyers. Absolutely.
Yeah, perfect. And so mortgage rates kind of, just again, give you perspective of where we're kind of stuck. And I think we're kind of stuck at these rates for a little bit. So I think we're sticking right about that 7%. What was interesting is I actually think that mortgage rates might go up a little bit, because after the Fed announcement this morning, the bond rates went up, and we usually have a couple points spread over those. So I actually, as much as I hate to say it, I think mortgage rates might go up a little bit in the coming month, but we're at about 7%. And if we look at the last 40 years, 70s, 80s, 90s, aughts, actually 50 years, I guess, we're about average. We're lower than the inflationary and high interest rate days of the 70s, 80s, 90s, but we're just about maybe a touch above where we're at in the 2000s, which was a more normalized time, at least for the first part before we went into the Great Recession. And so we're at that rate, and I think it's where we have to kind of accept as the new norm for the coming year. Steve,
Yeah.
As much as I say that, you know, the interest rates of 2, 3, 4%, I think we're a historical anomaly, and we begged and pleaded our buyers to take advantage of those. But I think that's a historical anomaly that we're not going to get back to unless there's some absolute giant disruptions in our economy, correct?
Absolutely. I mean, when you look back over 50 years, you see really two anomalies in there, right? Interest rates through the roof in the 80s and interest rates, at the floor in the 2010s. And at the end of the day, the rest of them are kind of in their range. And that's just what people have been accustomed to. And unfortunately, it's whatever's most recent is what's in people's minds. And so what was most recent was an environment that was artificially created.
Yep. And I'm not saying that this is good situation for home buyers. We're absolutely tapped people out on what they can afford. And it's not just here in Bend, it's nationwide. People are struggling, especially in the Western coast. The housing unaffordability combined with these high interest rates have absolutely maximized what people can pay for housing. And it's absolutely tapped them out. And when people used to pay 20 to 25% of their annual income towards housing, there's a lot of people now paying 40, 45, 50% of their annual cost towards housing, which puts people in a really delicate, tough situation and creates a lot of people that simply can't buy in this market, which gets to bigger, more macro issues that we've talked to about housing supply and growth plans of the cities and removing barriers to creating new developments and who's going to help fund these infrastructure costs. But I want to keep that outside of the talk today. But what we are seeing is inventory starting to finally free up. The last couple of years, we've had the lowest level of inventory that we've ever had on the market. And that was primarily derived by the fact that we shot from 3%, 4% interest rates up to 8% interest rates. And all these sellers were thinking about selling, but they were looking, even if they bought a house worth half of what they sold their house at, if they were to go get a loan, their mortgage payment was about the same or higher because of that step up in the interest rate. So we've seen a historical low, dating back 50 years, historical low of amount of resale activity that we're having. And we're largely dependent on new construction. And as much as new construction as we see in Bend in a few different areas, when you look at it as a percentage of overall population, it's extremely low. So the new builders simply can't meet up with this demand. And so that's what really drove up the prices during the pandemic and the year after. Where we stand now, and the reason inventory is starting to finally grow, is that the people that had their lives on hold, death, divorce, kids moving in, kids moving out, moving for a job, all those things that they put on hold because it wasn't right, is finally starting to come to a head, and people are saying, I need to get on with my life. This house doesn't fit my current needs. And we're starting to see some resale activity and some people listing their home. And we felt this starting to build over the last 2 to 3 months with a lot of people saying, hey, I'm going to sell this year. And now we're starting to see it happen. And I think this is a little bit of a tip of the iceberg. And this is where I'd like to transition the conversation to you, Steve, who's working with our sellers on a minute by minute basis, because I expect that inventory is going to continue to grow the next couple of months.
Yeah, absolutely. Yeah, if we go to local, one thing that I will say before we get too much into the details, there was an aspect as well coming out of the run-up that we had in 2021 and 2022, where builders were reluctant to do what they had done in the past, which was just overbuild and put new inventory out in the market.
Yeah.
And they were slow to release new inventory and weren't starting construction for a little bit until they had a signed contract in place. And now they've seen now for a period of a couple of years that the demand is still there, that the buyers are still there. And so they've upped the amount of homes that they're putting into production because they are getting absorbed. And so, if we look locally, our housing inventory is up 19.5% year over year. And the chart that we've got here is a rolling average because it can bounce around a little bit. This gives you a very good impression of the trends that are taking place. And we're up to 3.5 months. So just as a reminder, 3.5 months of inventory means at the current sales pace, it would take 3.5 months to sell through the existing homes that we've got if no new homes were to come on market. Now we've seen, as you can see in this chart, there were periods of time where it was, you can't even see it in this chart, that it was as low as 1 month or less than a month's worth of inventory because there just weren't enough homes to meet the demand. And so from that point to now, it feels like we've come up tremendously. And maybe it's even a little scary for people, which is why that first slide, the Menti poll, showed so much, well, I'm seeing so many homes and it's grown and it's grown. But the reality is, if you zoom out, this gives us a real perspective of what the last 20 years looked like.
Yeah,
And
I mean, Steve, those national headlines that are saying housing inventory is up by 25%, 50% in some markets is pretty alarming if you don't put it into context, right?
if you don't put it into context, and the context is that it was down 60% from where it was just prior to the pandemic. And so, yes, if we're comparing it, it's a little like the foreclosure discussion of how foreclosures a year and a half ago had doubled, but they were at virtually zero because of the forbearance programs. And so, there's a headline and then there's always a little asterisk that should be next to it. Not all the news channels put the asterisk next to it because they want you to get alarmed and tune in, but
Yeah.
that's where we come in. We really dive into this so that our clients can see exactly what we've got here. Where we've highlighted the range that we're in now is pretty typical range that we should expect. And this does, of course, take into account what happened between 2006 and 2009, which the reality is you don't generally, housing is very much a supply and demand market. It's very much driven by supply and by demand. And you generally do not see the price changes, the big price declines until you start getting into that 9, 10 months of inventory level. And that's kind of highlighted in red here. And once we crossed over that in 2006, it led to a point, Brian, just like you and I were talking about, it didn't matter what you priced your home for. They're just, the buyers had too many options and there were too many factors against them, and they were sitting on the sidelines. We're not at all in that. And if you look at this, you can see a very long history of us being in the range that, I mean, if everyone remembers the market from 2012 to 2020, when the pandemic started, it felt like a strong, healthy market. It was cyclical, as you can see, with seasonal fluctuations based on the time of year. And that's really pretty squarely where we sit right now.
Yeah, very helpful. Thank you.
Yeah. So Brian, you want to talk?
Yeah, so this is, Mark put together this quote. He's with Fannie Mae, and basically he was saying that a lot of buyers are out there, trying to be very strategic. And what we're seeing is that we're seeing buyer demand. This is not like the absence of buyers like we had in the early, 2007, 8 in the financial crisis, where people couldn't apply for or couldn't qualify for loans or couldn't buy, and unemployment was high. All those situations were really relatively, we have historic low unemployment. But we have a huge shortage in housing. Buyers are trying to buy in whenever they can. And we're seeing this show up in, if there's ever a temporary dip in the interest rates, if it goes from, 7.5 to 7.3, there's buying activity. If there's more than a month of consistent stability or increases in equities, the stock market, the luxury buyers are back in. And so what we're seeing is every time the door is open, even just a little bit, buyers are coming through that door. Back in 2008, 9, I remember you can open a door and say, hey, we'll take any offer on this house. And you couldn't get anyone to come through that door, metaphorically. And we're in a very different position right now. And so the buyers are there. They want to buy. A lot of them are frustratingly priced out no matter what happens. But I think this is where we kind of need to go from macro to micro and really talk about what's happening here, and what's right for you is very micro and very local. This is a point where we have a lot of forces normalizing appreciation, normalizing inventory, and the strategy is going to be about what's right for you and what's happening locally, not just in Oregon or Central Oregon or Bend, but like specific neighborhoods you're looking at. And so this is where, strategy matters. And I think we start ignoring some of the chaos and the headlines, and we kind of get, really granular.
Yeah, I agree with that. And, part of that is going into, let's get granular on what we are seeing locally in terms of the number of sales, what the total dollar volume is that's coming into the market in terms of those sales. And it's pretty clear. I mean, as you can see, the number of sales that we're seeing in Bend is dramatically lower than what we had been accustomed to prior to the pandemic. And, we've talked about this before. Part of that was the influx coming in, the number of people that jumped in those couple of years. You know, if you chop off the top of that chart and insert it into the last, flip it over and insert it to the last couple of years, that would kind of remain consistent in terms of the number of sales. We just had some people that jumped in a little earlier than what they would have done in 2024 or this coming year. But then when you look at the dollar volume, again, you chop off that anomaly over that 24-month stretch, and it's right on a long-term trend pattern that you would expect here. And this is the part that you were talking about, Brian, of affordability. We have a fraction of the sales, but we have a dollar volume from those sales at a level that's on par with what we would have seen, you know, just on a steady rate over the last 10 years. And so that tells us the homes that people are buying are significantly more expensive. And again, that's where you do need to create a strategy, speak with your lender, discuss different options for making it affordable, because you know, missing out on the home buying experience and owning a home and the long-term appreciation, and then the ownership, the value to yourself emotionally, missing out on all of that just because of the dollar volume or the prices, that there are ways that lenders can structure deals that do make it affordable to be able to get in and have that home ownership dream that you know many of us have. And so with the number of sales and that dollar volume, it's worth talking about what is the median home price right now. And so this is for single family homes. You know, you might see it quoted a number of different ways, whether it's Bend or Deschutes County, single family, all property types. But for single family homes, we're at 770,000. And what does this tell us? It tells us that we're pretty flat, where we still have our seasonal fluctuations. The market has not cratered. The market hasn't continued to take off. It has kind of fallen back into its normal pattern that if we zoom back out, just like we did on the other chart, you can see that normal pattern for years and years and years. I mean, decades. One thing that you don't see on this, and yeah, this is a rolling 6-month chart, is when you shorten this and you put it on a monthly basis, when you have so few homes selling, there are going to be periods of time where there are very expensive homes that sold and they make up a larger percentage of the homes that are selling. And so you might see those headlines. We saw it multiple times just recently. Median home price jumped 10% month over month. That's alarming. That is concerning. Or it drops 10%. And then you know, the naysayers are going, aha, here's that crash that we had expected. And the reality is it's a small sample set. And so when you have extremes at either end of it, it makes it feel like there's a big movement that is in actuality just an anomaly that when you zoom back out, you can see it's pretty clearly moving in the cyclical pattern that we've seen for decades.
Yeah, but this isn't exciting. It doesn't catch the headline.
It does not. This chart is a little more exciting. Do you want to?
Well, I'm sorry. I'm going to apologize to everyone that has to look at this, because I geeked out and dove into the data aggregator for the Bend MLS and then cross-synthesized this, and I got deep into AI yesterday. I even tried some of the new Chinese DeepSeek AI. Anyways, and I had them analyze the data, and what I did is I overlaid some different data sources that I got on a month-by-month basis for the last 5 years. Now, hang with me real quickly. The blue line is the amount of inventory homes that are for sale on a monthly basis. Historically, anywhere from about 1 to 600, 700 homes that are currently available. And then the red line is the number of homes that go pending in a month. And so what you'll see is on the far left side of this graph that in the like 21, we still had strength of the pandemic sales. The amount of pending sales were 2 to 3 times the amount of homes that were currently available, which means we were eating up inventory faster than it could come on, and that's what drove those prices up. You know, there were months there in middle of 2001 where we would sell 800 homes a month, and there was only 400 homes on the market. So basically we're turning over the inventory twice a month, and every home that came on sold. And that's what really drove up the price appreciation. When you look at like 22 and 23 and 24, that's more of a historical norm where there are more homes on the market than there are selling on a month-by-month basis. But what I wanted to pay particular attention to, and there's a lot of different takeaways we could do on this, but I want to pay a particular attention to what this means as a seller as far as micro timing and what your strategy, if you're thinking about being a seller in the year to come. Now, historically, and if I pulled a bigger data set, it would even look more confusing. But historically, what's the gap that's the shortest between the amount of homes that are for sale and the homes that are pending is lowest in January, February, March, and April. What does that mean? And this is the ratio that I synthesized down into this. Historically, in those early months of the year, there's only one or two, like there's a ratio of about 1 to 2 times the amount of homes that are on the market compared to selling. So that means if you're a seller in February, March, April, you have about 50% of the homes are selling. Now, when a lot of agents advise their clients, or a lot of people think about bringing their home on the market, they say, well, I'm going to go on in the summer, right? That's the best selling season. Now, it's just wrong. A lot of the sales post in the summer, but traditionally there's sales earlier in the spring. And why is that the case? If you go back in like the middle of this graph into 23, like January, February, March, April of 23, which is kind of dead center, there's about 2 to 3 homes on the market for everyone that sells. But when you go to the fall season that year, it's 3.5. And then as we go into 2024, it's even more pronounced. There was 2.5 and it went up to over 4. And so what traditionally a lot of sellers come on the market in the summer because there's more sales, but there's a heck of a lot more listings. And so traditionally, the most likely time that you're going to sell is in those very early months of the year. And traditionally, year after year, sellers are coming on the market a couple months too late. And then often when sales are already going down in June, July, August, inventory continues to decline. And that's what aids in that kind of cyclical price that Steve was talking about before. We traditionally see about a 6 to 8% price variation in the year. And that 6 to 8% lull every year is usually in the fall, early winter, when the homes that couldn't sell start doing those price decreases, and they have an average sales price of about 6 to 8% than what's sold in the spring. And so I think that's a takeaway for you as a seller, that if 2025 is in the cards, statistically, it's more likely that you'll sell if you get it in here in February, March, April, than it is later in the year. Steve, how would you then kind of correlate this to actions as a buyer for buyers that are absolutely frustrated on what they see in the market today?
So for a buyer, one of the things that we say is it's very similar when you're talking about like a seller who waits too long. They're also competing against more other sellers, and buyers are in that same category. Sometimes buyers think, I'm going to wait. There's going to be new homes that are going to come on the market. I'll just wait. And then they end up competing, or they end up getting in a situation where they miss out on something, or they just keep waiting for something new to come, or they just keep waiting for interest rates to come down. And then inevitably what happens is they've delayed the move. They're now moving later in the year or later in the season, depending on your demographic. There are things, if you're trying to get out of really hot climates, you want to be up here. If you want to get kids in school, you want to try to time that. And so the reality is, as with everything, I mean, even if you're not ready to buy as a buyer, now is the time to be watching the market and watching what homes are doing, how long they're taking to sell, how many homes are coming on the market, how quickly they're selling. And that brings us to our next slide, is to look through what do days on market look like. And this also is a very cyclical thing. And like Brian said, as the year goes on and some of those homes that have been on the market for a while, as those start to sell, the data set will show a large number of days on market. We're up 72% year over year on days on market right now. There was a period in time where you can see the averages were just a mere less than a week. Right now, we're at about 20% of the homes that come on the market sell within a week. Even in a market where we've gone up 72% year over year, and we're at 2 months for average days on market, about 20% of the homes still sell within a week. And so for homes that are well-positioned, well-marketed, well-priced, there is absolutely buyer demand out there right now. And there is a very good opportunity, if you're a seller, to put it in front of those people when there aren't a lot of other people out there. And if you're a buyer, you can look at this and go, well, days on market does tend to drop. What does that mean? Well, that does mean that there are more people in the market, and there might be more people that you might compete against. And so the reality of all of this, and again, this chart, we only pulled up 3 years going back to when it was a frenzy in 2021. But if we scroll back and pull up a long chart, which we do have in our monthly market reports, you can go back onto our website and pull those up, and you can see that we are right near historical norms. This is absolutely what we were very accustomed to, and that's healthy for buyers. You don't always have to decide in the first time that you visit a home. You can have a moment, a week, sit and think through, maybe get back in the house again. But yeah, right now, about 2 months is the norm. And so, let's talk through what does this mean for buyers? What does this mean for sellers? Inventory is growing, still near long-term averages, and don't get too caught up in the headlines about how much it's moving. We will expect more inventory to come on the market this spring. Absolutely. They might even wait, like you said, Brian, sellers might wait just a little bit too long. But there are definitely people that are trying to time it just perfectly. At the end of the day, there's a fundamental decision that you're trying to decide. And if you look at the fundamentals of the market, putting yourself out there when there aren't as many homes available is usually advantageous. If you're waiting for lower interest rates or some path of action, you're on the same timeline as many other people are. And the reality is all of the expectations are what we see right now is probably going to be pretty similar to what we see down the road when it comes to interest rates. And it says prices didn't decrease with already historic drop in sales. Waiting for a significant price drop with increasing sales is unlikely. Like we talked about, the reality is we can see it every day. There is buyer demand out there. And we didn't see a big price reduction after a big price correction after a historic run up. What we saw is a pretty quick return to what a normal pattern that we've seen in Bend for 20 years. Brian, you want to go through some seller points?
Yeah. So what I would like to talk about is what we're starting to see is that lock-in effect of interest rates that held sellers from selling their homes is starting to break. Like I talked about before, they want to get on with their life, and they realize that there are different aspects to owning real estate, and it's not pure 100% investment like owning a stock. It's their life, their lived experience is attached to that. And so people are starting to break that and kind of get on with it. And so the seller inventory is coming. And then the buyers on the other side of that, they're getting on with life. And if they can qualify, not everyone can, if they can qualify, they're starting to accept the rates of today as the rates of today, and they're getting on and starting to buy. So that increased competition is coming. We do expect that inventory to continue to climb. One, anecdotally, we're having more conversations with sellers this January than we've ever had in January, right, Steve?
Absolutely. Yeah.
Yeah. So sorry. So anecdotally, we're having more, seller discussions earlier in the year than we ever have, but we're also seeing it show up in the inventory traditionally earlier than we have in the past. So I think if you're saying, oh, I'm going to sell in the next I want to sell in 2025. If 25 is really in your cards, I would encourage a conversation now. And then also for those that are waiting for some kind of, hey, I wanted to appreciate, great. But we don't see any experts out there that are predicting big jumps in price increases. This is not in 2020 when the sellers held all the cards, buyers wanted to buy, and there was no inventory in the market, and they could expect to extrapolate from their neighbor sell another 10%. Those days are squarely over. And so it's a much more modest price forecast. So it gives sellers you kind of take that out of the equation. And so it's really on your timing more than anything else. And so, Steve, I actually think we got through what we had today faster than we ever have. I do have one question that was sent to us, and I think there's kind of two parts, and I'll let you jump in on the second part. I'll take the first part. They said, one, within their price range, do townhomes appreciate as well as detached single-family homes? And I'm going to say yes and no. So traditionally, the more unique the property is, the more control you have over the pricing. When you have a condo or when you have a townhome, if there's a flurry of sales, those comps quickly drive up in price because they're all very relatively the same. And when the sales go up, they can track up and you can see rapid appreciation. But also in times when there's one or two distressed sellers and the price comes down, it kind of re-baselines everyone. So I wouldn't necessarily say, do they appreciate faster or slower? I think they're more cyclical and more variable than single family homes. Steve, does that resonate with you?
Yeah, absolutely. I mean, that's a great.
Okay. And then do you have the third part of that question, second part of that question?
I can't see the chat, but I do know the question that had come in before was with regard to appraisals.
Yeah.
And it sounded like there was a buyer transaction or someone was selling their home. The buyer had an appraisal done and it came in short. And so the question was, it sounds like maybe that triggered a renegotiation by the buyer to say, hey, the house isn't worth what you have it listed for and what we agreed on. And it's a
It
probably.
sounds like they made a concession. We don't have all the details. They just said,
Yeah.
hey, we had to decrease the price to the buyer. Did I, and so we don't have all the details, but take a crack at what we often deal with in that scenario.
Yeah, so the question was regarding, is it best to have an appraisal done in advance? And you absolutely can do that. A buyer is going to have a lender is going to require an appraisal be done and be ordered through a certain party so that there's nobody's touching the appraisal that shouldn't be touching it. And so if that gives you some extra assurance, what we work with our sellers on, what we talk to them about is having the most accurate price for two reasons. One, you want to avoid this situation, and two, you want people to walk in and to feel this feels right. This feels good. This feels, yes, I can see myself in this home, and this home feels like it's accurately priced based on the comps. When you go in and it is even just marginally too high and you start inserting in buyers' minds and it feels like a little bit of a stretch, that's where you end up in those situations where then you are doing price reductions, or like in this case, perhaps ending up with an appraisal gap when the lender or when the appraisal comes out there. So it's one of the reasons why we like to have those conversations very early on. We like to talk through individual homes and how they compare, and we put a lot into the value process because this is big. We're going to start a process and you're going to start thinking about getting on with your life, and we want to make sure we're putting you in the best position to have it exposed to the right number of people and have them feeling this is accurate, and then when it gets in contract that it's going to be seen through.
Yeah, and I think there's a lot of confusion in this market. What's frustrating for us is, 25-year experts in the industry, sometimes we lose listings or people choose to list with other agents because other agents are promising them these super high prices. But when it comes to the reality, the market is not perfect, but the market is fairly accurate, and it'll ultimately determine what your house value is worth. And what we're seeing in this market right now in kind of two regards. One, homes that are overpriced when inventory is growing and buyers are still struggling to pay. The overpriced homes are absolutely struggling. And those are the ones that you're seeing the price decreases day after day after day. And once you've had your home on long enough and you've stigmatized it enough with price decreases, it kind of sets the tone down. Or ultimately, like what Steve was talking about, and kind of the second part of this is every once in a while you get someone to grab onto that price, but then often a bank's not going to just lend willy-nilly. They're going to require an appraisal on it, and often those deals fall through, and then a seller has to come back on the market with their tail between their legs, either at that or a reduced price, or they have to renegotiate during the process. So accurate pricing matters. And when you have a listing agent that's really arguing with you on price, it's not necessarily, they want to maximize the sale price for you, but they really want to talk to you about the validity and the probability of it actually selling. And so I see a couple other questions popping up. There's one here. Do you think there will be any impact to the California fires on the local market in Bend? And I'll do a little answer on this, and then Steve, why don't you take it? Dating back to the, the Paradise Fire a couple of years ago in California, we even saw an impact in Bend from that. And that wasn't historically a feeder market. That area wasn't a feeder market to Bend at all. And we did see buyers enter the market that had, settlement checks in their pocket, not wanting to rebuild, ready to move to Bend. And I think this one will have an effect on us because I was just in a mastermind with some agents from LA yesterday. They're seeing price gouging on the homes that are for sale, huge increases in price, and sales and multiple offers on homes that even 3-4 months ago were absolutely crickets. And then we're also seeing price gouging on rentals. I talked to one agent, and she said there was homes that were renting for $5,000 to $7,000 a month there 2 months ago. They're asking $50,000 a month. I mean, a 10x. And some of this will go away and normalize over time, I'm sure. But anyone that was kind of on the bubble of leaving that area for Bend, I think this was the impetus, and it's gonna be the trigger to get people here. And LA is an increasing buyer set for Bend. 5, 6 years ago, it wasn't. When we started getting direct flights to LA, I would say that the LA set probably makes up about 10% of our buyer set at this point. So I do think this will have an impact. And we're already starting to see some earlier sales. It's not showing up in the data yet, but we're seeing more sales here at the end of January than we have in the last 5 or 10 years. And I don't want to get too far ahead of myself over a couple-week trend, but I think this is playing into it a little bit. Steve?
Yeah, there's no question. I mean, the reality is, generally speaking, it's people are leaving wherever they're leaving because of something that impacts them, whether it's the size of their house or the climate around them or the fear and the risk of a fire. Insurance numbers. I mean, I spoke with someone from North County and LA today, and their rates have gone up 4 and 5 times already. And now the projection is that they're going to go up another 5 or 6 times, or in certain cases, like you've heard, some insurers have just pulled out altogether. And so usually there's like one thing that just kind of puts them over the edge. And there's no doubt this has definitely led to an increased number of calls and people finally going, all right, I've been thinking about this for a while. I'm at my point. It's time. And so, yes, absolutely. And I know there are some other ones. I can't get the chat up on my end, and I know
Ronald, you were saying there's one more Q&A, but I don't have access to that either. If you've got that for us here in the next 10 seconds, let's try to answer it. If not, we didn't get to a question, I apologize. Send us a follow-up. And then what we're going to be doing is sending a copy of this to everyone that was here today or registered. Feel free to send it on to other people. We're going to post this on our website. We update monthly stats there on the market as well. And then, of course, we're always one phone call away from a private meeting. But Steve, thank you for your time today. Once again, I lied. It's not 20 or 30 minutes. We want to 42 again. You need to cut me off. But anyways, thank you all for attending, and please use this as a resource as the year progresses.